Hey, welcome back guys, Lad here. It's the new year. 2023 is finally here. Hope 2022 was a good year for y'all. I know it was a good one for me, but I'm gonna need your guys' help to make 2023 an even better one by hitting that like and subscribe button down below. It is completely free for you guys and it would only take 5 seconds. In return, it would make my year so much better and encourage me to continue to make these videos to help you in your investment journeys. I appreciate the support from each and every one of you. Alright, it's a brand new year, but the same economic problems still worry us investors daily. The Federal Reserve is expected to continue raising interest rates, which in turn will continue to worsen the stock markets, sending many experts in fear of another year of recession for the stock market. There are some upsides in these circumstances. In a time of economic recession, oftentimes it is the best time to buy as there is a high growth potential in the market. Today, I'll be talking about 5 companies to keep on your outlook for 2023.
Disclaimer, this is not financial advice as past performances never guarantee future performances.
Everything I talk about in this video is based off of my own personal research and analysis. Always be sure to research any companies in depth yourself before making any investment decisions. Alright, without further ado, let's start with the number 5 company on my list, and that is Home Depot. Home Depot is down 23% in 2022. If this is the case, why should you keep an eye out for this company? Well, for starters, home improvement is not going anywhere. Every house or building suffers wear and tear on a daily basis. That makes Home Depot products essential to everyday use. In addition, the real estate market has been very profitable in the past few decades. Homeowners are always looking to improve their homes, either to live more lavishly themselves or sell their assets at a more premium price. They will look towards Home Depot to supply those materials necessary to make those improvements. Another attractive attribute with Home Depot is its low 19 PE ratio. This gives Home Depot an advantage over its number 1 competitor, Lowe's. If y'all aren't familiar, the price to earnings ratio simply relates a company's share price with its earnings per share. Generally speaking, the lower the company's PE ratio, the better value this company is to buy. In addition, Home Depot is a good long-term hold as it pays a solid 2.3% annual dividend yield. This equates to $7.60 per share of passive dividend income paid to you annually. This number has steadily increased each year since the financial crisis when Home Depot resumed their dividend payments. We can expect these increases to continue in the near future. In addition, many analysts are expecting one of the biggest housing corrections since World War II, with many experts predicting a 10 to 15% decrease in the price of homes halfway through 2023. This fact, in conjunction with the Federal Reserve expecting to halt interest rates, will result in a strong housing market by the end of 2023. This expected increase in home buying will result in the demand of Home Depot supplies to soar sky high. At the number 4 spot is Tesla. Seriously, what happened to Tesla? At one point last year, it was the most hyped up stock. Everyone and their grandmothers were helping Elon Musk become the world's richest man. But the tide started turning in the beginning of 2022. We saw that the market began shifting away from tech stock. Many tech companies like Meta, Alphabet, and Microsoft saw sharp declines in their share prices. Tesla was no exception. By the end of September 2022, Tesla was down 25% from the beginning of the year. But the worst has yet to come. Elon danced with the idea of purchasing Twitter throughout the past year, but it wasn't until late 2022 when the deal was finalized. As a result of this purchase and some recent controversy, Tesla's share began to plummet. Through the acquisition of Twitter, Elon began selling off some of his share stakes in Tesla, which resulted in the company's share price suffering even more. This past year, the stock has plummeted down more than 70%. But what is the best thing about stocks? Most of the time, what goes down must come up eventually, unless the underlying company shifts its structural base. With Tesla's innovative approach, it is unlikely for a company this large to not bounce back. Keep a watch out for Tesla, as I believe it is near the bottom, making a great buying opportunity. The backbone of Tesla, with their innovation to merge technology with electric vehicles, is still strong at its core. If Elon Musk can get his act together, there's no doubt in my mind that the company can bounce back in 2023 once again to retain its upwards trajectory. At the number 3 spot is Emergent Biosolution. This company has had a long association with the US government, but it was not until 2020 when COVID-19 hit did the share price skyrocket. This in large part is due to the fact that the Department of Health and Human Services Biomedical Advanced Research and Development Authority, acronym BARDA, came to emergent in request for a massive manufacturing scale-up of the COVID-19 vaccine. This, along with a partnership with some of the largest biomedical companies such as Johnson & Johnson and AstraZeneca, resulted in a 168% increase in its share price from March 2020 to early 2021 before the price began to ski. Today, the price of each share in this company is roughly $13, down about 73% this past year. The price to earnings ratio of this company is at a very favorable 5.32. The reason to keep an eye out for this company is due to the recent surge in COVID cases over in China. Many experts believe that the surge is in large part due to the weak and ineffective vaccine that China is producing. It is believed that China will soon start to import US vaccines and turn to the likes of Pfizer, Moderna, and Johnson & Johnson. As a result, Emergent Biosolution could be in line to start up productions again and mass produce millions of doses of vaccine to try and rescue the sick patients in China. Investors that get in at the right time and buy Emergent shares could come out very profitable. At the number 2 spot, we have the JP Morgan Nasdaq Equity Premium Income ETF, or JEPQ. This is the first ETF on the list. JEPQ is composed of mostly companies from the Nasdaq 100 index with top holdings in Microsoft, Apple, and Alphabet. It is relatively new as it was formed in May 2022. This makes it impossible to evaluate its performance in a historical manner. The only fact is that since its inception, it has been down about 21%, trading at about $40 a share. This is expected as over the past year, the Nasdaq has been down about 31%. Buy low and sell high should be the approach all successful investors should take. Aside from this reason, what makes this ETF such an eye-catcher is the unbelievably high dividend payouts. Unlike the other traditional dividend-paying ETFs such as SCHD or SPHD, JEPQ is unique in that it uses a cover call strategy to generate the immense dividend payout to its investors that other rivaling companies, the likes of SCHD and SPHD, could never dream of generating. JP Morgan does this by selling 1 month out of the money call options as a way to hedge against this time of recession. At the time of this recording, JEPQ is currently running a 9.44% dividend yield, equaling to about $3.85 in dividends per year for each share. Since 2023 is going to be a year full of uncertainties in the market, JEPQ, with its high dividend payments, is a great company to consider. Topping off our list is a company everyone is familiar with, Amazon. Very similar to Tesla, Amazon has lost almost 50% of its value since the start of 2022. Like many other e-commerce companies, Amazon's value soared over the time of peak COVID restrictions. It was up almost 160% from early 2021 to mid-2022. This extreme growth is not sustainable for any company, especially one that benefited so much from abnormal circumstances COVID-19 brought. Throughout this past year, we are witnessing Amazon return back to normality with a recent 52-week low at a price of $81.82 per share. This is a great price to own one of the world's most successful companies in the past decade. Amazon is still the biggest e-commerce company in the world with a market cap over $1 trillion, beating the likes of Alibaba and Walmart. With the steady leadership of Bezos, we have no reason to short Amazon in the long term as it is expected to see major growth in the next decade. With the growing popularity of e-commerce as many shoppers' top choice, Amazon is a great company to look into and potentially adding to your portfolio in 2023. Alright guys, that's all I have for you today. Hope you found this video useful for your investment journey. If you guys are new to investing and want to sign up to an easy to use brokerage account, check out the link in the description below. Let me know in the comments what other topics you guys would like to see. Before you leave, here are some other videos I think you might enjoy. And ciao until next time.